Most people think they lose money in a crash because they take too much risk, but that is not what usually happens. The real damage often comes from something much more dangerous. It comes from trusting the wrong things to be safe. Think about it. When markets start falling, people run toward safety. They move into assets they believe will protect them. Things like index funds, real estate, bonds, cash, and big well-known stocks. These are supposed to be the strong ones, the stable ones, the ones that hold up when everything else breaks. But here's the problem. In almost every major crash, these safe assets do not protect people the way they expect. In fact, many of them get hit early. Some fall fast, others fall slowly, but they still fall. And by the time most people realize what is happening, the damage is already done. This creates a dangerous illusion. You feel safe right before things start to crack. And that is exactly why this matters. Because people do not lose money just because markets drop. They lose money because their plan was built on the wrong idea of safety. They thought they were protected. They thought they were being smart, but they were standing in the same crowded place as everyone else. So in this video, we are going to break that illusion. We are going to go through 5 assets that are called safe, trusted by millions, and used in almost every portfolio. But when a real crash hits, these are often the first ones to get destroyed. And once you see why, you will never look at safe investing the same way again. Before we go into the list, we need to fix one big mistake. Most people use the word safe in the wrong way. They think something is safe if it feels stable, looks familiar, or has worked well in the past. If the price does not move too much, they feel calm. If everyone else owns it, they feel even better. It seems logical. But this way of thinking breaks down fast in a real crash. Because safety is not just about what an asset looks like on the surface. Real safety depends on what happens under pressure. Ask yourself simple questions. Can you hold this asset when fear is everywhere? Can you keep it if your income drops? Can it survive rising interest rates? Can it keep its value when inflation rises? And most important, what happens if everyone tries to sell it at the same time? These are the questions that matter. In normal markets, things feel smooth. Prices move slowly. Losses are small. It is easy to believe that your plan is solid. But in a crash, everything changes. Fear takes over. People stop thinking long term. They want out fast. And here is where the real problem shows up. In panic, people do not always sell the worst assets first. They sell the easiest ones first, the ones they can exit quickly, the ones they already own in large amounts, the ones that feel safe but are also crowded. That is why so many safe assets get hit early. They are liquid, they are popular, and they are easy to dump. So safety is not just about low risk. It is about how an asset behaves when pressure builds. It is about who else owns it. And it is about whether you can actually stay invested when things get ugly. Now that you understand that, the list you are about to see will make a lot more sense. Let's start with one of the most popular safe investments in the world, index funds and broad ETFs. Almost everyone has heard the same advice. Just buy the market, keep it simple, stay diversified. Over time, you will be fine. And to be fair, this idea has worked for a long time. That is why so many people trust it. It feels safe because you're not betting on one company. You're buying hundreds of them at once. If one fails, the others can carry the weight. It sounds strong. It sounds balanced. It sounds protected. But here is where things change during a crash. Index funds are some of the easiest assets to sell. With one click, you can exit your entire position. No waiting, no negotiation, no delay. And millions of people hold these exact same funds. So when fear hits the market, something important happens. People do not stop to think about what is inside the fund. They do not ask which companies are strong and which are weak. They just want out. And the fastest way out is to sell the whole thing. This creates a wave. One person sells, then another, then thousands, then millions. Because everyone owns the same basket, the selling pressure hits everything at once. Prices drop fast, much faster than most people expect. This is why diversification can feel like it disappears right when you need it most. In calm markets, spreading your money across many companies helps reduce risk. But in a crash, many assets start moving in the same direction, down, at the same time. And that shocks people. They thought they were protected. They thought owning the whole market meant stability. But instead, they watch the entire market fall together. There's also another hidden issue. Because index funds are so popular, they become crowded. When too many people are in the same trade, the exit becomes tight. It is like everyone trying to leave a building through the same door at once. It does not matter how wide the door looked before. In panic, it feels small. This does not mean index funds are bad. They can still be powerful tools over the long term, but they are not crash-proof. They can fall hard, and they can fall fast. And if you believe they will always protect you in a downturn, that belief can cost you, because the moment you expect safety the most is often the moment the illusion breaks. Now let's talk about something many people believe is even safer than stocks. Government bonds. If you have ever looked at a basic portfolio, you have probably seen this idea. Stocks for growth, bonds for safety. When stocks fall, bonds are supposed to hold steady or even go up. That is the common belief. And for a long time, that belief made sense. Governments can raise taxes. They can print money. So lending money to them feels secure. That is why bonds are often called low risk. They are used in retirement accounts, pension funds, and conservative portfolios all over the world. But here is what most people do not fully understand. Bond prices do not stay fixed. They move. And one of the biggest forces that moves them is interest rates. Here's the simple version. Imagine you bought a bond that pays a certain amount each year, then new bonds come out that pay more. Suddenly, your older bond is less attractive. If someone wants to buy it, they will only do so at a lower price. So the value drops. That is how rising rates can hurt bonds. And when rates rise quickly, that drop can be sharp. This is exactly what surprised many investors recently. Bonds did not protect them. Instead, they lost value at the same time stocks were falling. That is a double hit. The problem is not that bonds are useless. The problem is the expectation. People expect bonds to always act as a shield. But in some environments, especially when inflation is high and rates are rising, that shield becomes weaker. And there is another layer to this. Just like index funds, bonds are also widely owned. Large funds, banks, and everyday investors all hold them. So when conditions change and selling begins, it can spread quickly. Now, you have a situation where an asset designed to reduce risk is suddenly adding to it. That is where people get caught off guard. They built a balanced portfolio. They followed the rules. They thought they were protected. But when both sides start to fall, the plan feels broken. And that is the key lesson here. Low risk does not mean no risk. And something being called safe does not mean it will hold up when pressure builds. Because in a real crash, even the assets meant to protect you can become part of the damage. Now let's move to something that feels even safer than bonds. Cash. At first, this one seems simple. Cash does not go up and down like stocks. It does not crash on a chart. It does not swing with the market. When everything feels uncertain, holding cash feels calm. It feels like control. That is why people say, cash is king. And in some situations, that is true. Cash gives you flexibility. It gives you options. It lets you wait while others panic. There's real value in that. But here's the part most people miss. Cash does not stay still in the way they think it does. The number in your account may not change, but what that money can buy can change a lot. And when inflation rises, it changes fast. Let's make this simple. If you have $1,000 today and prices go up, that same $1,000 buys less tomorrow. Maybe food costs more. Maybe rent goes up. Maybe everything feels more expensive. Your money did not move, but your power to use it got weaker. That is a loss. It is just a quiet one. This is why cash can slowly lose value without you noticing. There is no big drop on a screen, no red chart, no sudden panic. It just fades over time. And that is what makes it tricky. People feel safe because they do not see the damage happening. They look at their balance and think everything is fine. But in reality, inflation is eating away at it in the background. Now, this does not mean cash is useless. Far from it. In a crash, cash can protect you from panic decisions. It can give you time. It can help you take advantage of opportunities when prices are low. That is powerful. But holding too much cash for too long, especially in a high inflation environment, can slowly work against you. So there is a balance. Cash can protect you from sudden drops, but it cannot always protect you from slow loss, and that loss can add up in a big way over time. That is why it is important to see cash clearly. It does not crash like other assets, but it does not stay strong forever either. Now let's talk about the asset many people trust the most, real estate. For a lot of people, property feels like the safest investment you can own. You can see it, you can touch it, you can live in it. It feels solid, it feels permanent, and you have probably heard this before. Real estate always goes up over time. That belief is very strong. But in a crash, real estate can become much more fragile than it looks. The first thing to understand is that a property is not just an asset. It is also a financial commitment. There are monthly payments, taxes, maintenance, and sometimes debt. And the debt changes everything. Most people do not buy property with full cash. They use a mortgage. That means they are using borrowed money. And borrowed money can turn a slow problem into a fast one. Here is the simple idea. As long as you can make your payments, you can hold the property, you can wait, you can ride out changes in price. But if something goes wrong, that changes quickly. If income drops, if rates rise, or if costs increase, the pressure builds. And if you cannot keep up with the payments, you may be forced to sell. Or worse, lose the property. That is where the risk shows up. Real estate does not always crash first in price, but it often cracks when people can no longer hold it. And there is also another issue. Real estate is not easy to sell. You cannot click a button and exit. It takes time. Buyers need loans. Deals fall through. And in a downturn, buyers disappear. Demand slows down right when sellers start to show up. This creates a trap. People think they can sell if they need to. But when they try, they find out the market is not there. Prices start to fall, time stretches, and stress builds. Now the asset that felt safe starts to feel heavy. There's also the emotional side. Owning property feels secure in good times, but in bad times, that same ownership can turn into pressure. Payments do not stop just because the market is down. Bills still come, and if too many people face the same problem at once, the system feels it. This is why real estate can move slower, but still move in the same direction as other assets during a crisis. People think it is safe because it does not change price every second. But sometimes it is just changing behind the scenes, and when it finally shows, the move can be painful. So the real risk is not just price, it is timing, debt, and your ability to hold on when things get hard. That is what truly decides whether real estate protects you or hurts you in a crash. Now let's look at the last one, blue chip stocks. These are the big names everyone knows, huge companies, strong brands, long histories, the kind of businesses people feel comfortable owning for years. When someone wants to play it safe in the stock market, this is usually where they go. It makes sense. If a company has been around for decades, if it makes billions, if everyone uses its products, it feels reliable. It feels like it should hold up better than smaller, riskier companies. But here is what often gets overlooked. Size does not protect a stock from falling. In fact, sometimes it does the opposite. Because these companies are so well known, they are owned by almost everyone. Individual investors, large funds, retirement accounts, institutions, they are everywhere. And that creates a hidden risk. When fear hits the market, people do not just sell weak companies, they sell what they own. And a lot of people own the same big names. This creates pressure. It is not always about the company being bad. It is about people wanting to reduce risk, raise cash, or just get out. And when millions of people try to do that at the same time, even the strongest companies can drop hard. There's also something else at play. Familiarity builds comfort, and comfort can lead to overconfidence. People assume these companies will always recover quickly. They assume they are safe just because they are big, so they put more money into them without thinking about what could go wrong. Then when prices start to fall, that confidence gets tested. At first, people wait. They believe it will bounce back. But if the drop continues, the mood changes. Patience turns into worry. Worry turns into fear, and fear leads to selling. Now, the same popularity that made these stocks feel safe becomes a weakness. Too many people are heading for the exit at the same time. And just like before, it is not about the company disappearing overnight. It is about how the market reacts in the moment. Prices move based on buying and selling. And in a crash, selling can take over fast. So even the biggest, most respected companies can see sharp declines. That is why it is important to separate the business from the stock. A great company can still have a falling stock price in a crisis. And if you believe size alone will protect you, that belief can lead to surprise losses. Because in a panic, even the strongest names can get pulled down with everything else. Now, if you step back and look at all 5 of these assets, a clear pattern starts to show. They all feel safe on the surface. They are popular, they are trusted, and they are owned by millions of people. But that is exactly where the hidden risk comes from. These assets are crowded. When too many people believe something is safe, they all move into it. And that works fine in calm markets. Prices go up slowly. Everything feels stable. Confidence builds. But in a crash, that same crowd becomes a problem. Because when fear shows up, people do not move one at a time. They move together. And when they all try to exit at once, the pressure builds fast. That is why these assets often get hit early. They are easy to sell. They are widely owned. And they are trusted a little too much. It is not just about the asset itself. It is about how people behave around it. If something is easy to buy, easy to sell, and owned by everyone, it can turn from safe to risky very quickly under pressure. So the real lesson here is simple. The problem was never just the asset. The problem was the illusion of safety. So what does real safety actually mean? It is not just about picking assets that sound safe in good times. It is about choosing things that can still protect you when conditions change. When fear rises, when rates move, when inflation hits, and when people start selling at the same time. Because the next crash will not just punish risky behavior, it will punish weak definitions of safety. So the real question is simple. Which of these safe assets do you trust the least now? Let me know below.